78. General Studies, Mains, Paper 2. Ensuring institution liquidity. It aims at securing international convergence on regulations governing the CAR. The supervisory review process on the bank's internal process and system, while the market discipline focuses on market disclosures being made by the banks. These two pillars reinforce the pillars of minimum capital requirement. CAR is held in the form of shareholders' equity and certain other defined classes of capital. Basel III. It seeks to strengthen the existing capital requirements and introduce a global liquidity standard to enable the banks to weather financial storms. It mandates the banks to increase the loss absorbing capital from 2% to 4.5% by January 2015. Also, banks will be required to hold a capital conservation buffer of 2.5% to withstand future period of stress. Basel II, therefore, increases the quantum of capital which banks will be required to maintain. Basel III norms define the capital of the banks in different ways. It considers common equity and retained earnings as the predominant component of capital, but restricts the inclusion of items such as deferred tax assets, mortgage service rights and investments in financial institutions to no more than 15% of the common equity component. Basel III were fully implemented from the 31st of March 2019. Basel III Guidelines, 2015. The Reserve Bank of India, RBI, released on the 28th of May 2015, the draft guidelines on the Net Stable Funding Ratio, NSFR, under Basel III framework on liquidity standards for banks. The NSFR is defined as the amount of available stable funding relative to the amount of required staple funding. The objective of the NSFR is to ensure that banks maintain a stable funding profile in relation to the composition of their assets and off-balance sheet activities. In draft guidelines released, the central bank said that banks will have to maintain Net Stable Funding Ratio, NSFR, from January 2018. Important terms used in banking. Liquidity Adjustment Facility operations. The liquidity management operations are targeted at tuning liquidity, so that the overnight prices in the money market remains within the abstract boundaries established by the repo and reverse repo rates for the LAF operations. When RBI goes through with a repo transaction, liquidity is infused into the system, while in a reverse repo transaction liquidity is absorbed from the system. In the former case, RBI takes securities as collateral, while in the latter RBI provides securities to counterparties. The LAF auctions are conducted once or twice a day and that sufficiently modulates overnight liquidity conditions. Market Stabilization Scheme, MSS. The MSS was launched in April 2004 to strengthen RBI's ability to conduct exchange rate and monetary management. The bills bonds issued under MSS have all the attributes of existing Treasury bills GSECs. These securities help RBI in managing liquidity. These are issued not to meet the government expenditure and as such has a negligible effect on fiscal deficit of the government. These securities are issued by way of auctions to be conducted by RBI. The of auction along with amount and tenure of such securities are decided by RBI. Marginal Cost of Funds-Based Lending wrote, MCLR. MCLR came into effect in April 2016. It is a benchmark lending rate for floating rate loans. This is the minimum interest rate at which commercial banks can lend. This rate is based on four components: the marginal cost of funds, negative carry on account of cash reserve ratio, operating costs and tenor premium. MCLR is linked to the actual deposit rates. Hence, when deposit rates rise, it indicates the banks are likely to hike MCLR and lending rates are set to go up. Under the MCLR regime, banks must adjust their interest rates as soon as the repo rate changes. The implementation aims at improving the openness in the structure followed by the banks to calculate the interest rate on advances, besides effective monetary policy transmission.
మ్యాన్ మ్యాట్రస్ ఎంత అది ఊరు ఈరోజు నైట్ రావా?
Banking and inflation. 79. Non-performing assets, NPA. ANPA refers to a classification for loans or advances that are in default or in arrears. They are recorded on a bank's balance sheet after a prolonged period of non-payment by the borrower. As per the RBI norms, banks are supposed to classify an asset as NPA where payment remains overdue for a period more than 90 days. An agricultural loan becomes NPA when the payment remains overdue for various crops, for instance in short-duration crop paddy, jowar. If installment or interest is not paid for 2 seasons, it will be treated as NPA. NPA crisis in India. The gross non-performing advance, GNPA, ratio of scheduled commercial banks was at 10.1% in January 2019, where for public sector banks, PSBS, it was at 13.9%. When restructured and unrecognized assets are added, the total stress would be 15 to 20% of total loans. NPA problem in India is worst when compared with other emerging economies in BRICS. 5 sectors which contributes more than 50% of total stressed advance are mining, iron and steel, infrastructure, aviation and textile. This NPA crisis may have several negative implications in economy, such as lack of fund for important projects, lowering of profit margins of lenders, higher interest rate charged by the banks to maintain the profit margins, among other. The twin balance sheet problem, which is both cause and effect of NPA, can half the investment-led developmental process. It will also lead to lower growth rates and higher inflation because of the higher cost of capital. Government measures to tackle the NPA crisis. Recognizing the adverse impact on overall economic health of the country, the government has taken various steps since 1991, when Narsimham Committee suggested many reforms to tackle NPAs. They are given below in summarized forms. 6 Debt Recovery Tribunals, 1993, they were created to help banks recover bad loans. They are governed by the provisions of the Recovery of Debt Due to Banks and Financial Institutions Act, 1993. Due to insufficient number of such tribunals and rising case of litigation, they 100 started getting a backlog of litigations. Lok Adalats, 2001. They were primarily aimed at recovery of small loans of up to *5 lakh from various borrowers. They played significant role in settlement and loan recovery. SARFAESI Act, 2002. This act permitted banks and financial institutions to tackle the NPAs without the involvement of the court. It applied to loan above 10 lakhs, and banks were allowed to take ownership of debtors' assets and sell those confiscated property without the involvement of court. IV Asset Reconstruction Companies, ARC, under Banking Regulation Act, a bank can only keep an immovable property in its possession for 7 years, or up to 12 years without the permission of RBI. Evers otherwise, it is not healthy for banks to hold on to such assets for so long because assets can depreciate. Asset reconstruction companies, ARCs, were allowed to help resolve this issue. They helped unlock value from stressed loans. V. Strategic Debt Restructuring, 2015. Under this scheme, banks who has given loans to a corporate borrower gets the right to convert the complete or part of their loans into equity shares in that company. It provided banks with enhanced capabilities for initiating a change in ownership in appropriate cases. V. Insolvency and Bankruptcy Code Act, 2016. With the basic aim to solve the twin balance sheet problem of the Indian economy, this act was enacted in 2016. The aim of this law is to promote entrepreneurship, availability of credit, and balance the interests of all stakeholders by consolidating and amending the laws relating to organization and insolvency resolution to corporate persons, partnership firms, and individuals in time-bound manner.
చూడు 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 మళ్ళా చూడు అడిమా
General Studies, Mains, Paper I. V. Recapitalization, 2017. Government of India announced recapitalization of PSBS to the tune of 211 lakh crore in October 2017, through infusion of capital by the government and raising of capital by banks from the government. Apart from these policies and reforms, government also launched Mission Indradhanush in 2015 to bring out transformation in PSBs in context of appointment, empowerment, accountability, and separate Bank Board Bureau, BBL, was also created. Important Committee of Banking Reform. Urjit Patel Committee on Monetary Policy Framework. Urjit Patel Committee was appointed to examine the current monetary policy framework of the Reserve Bank of India, RBI. Following are the important recommendations of the committee. The committee suggested that the Apex Bank should adopt the new Consumer Price Index, CPI, as the measure of the nominal anchor for policy communication. The nominal anchor or the target for inflation should be ESR at 4% with a band of plus 2% around it. The committee asked the central government to ensure that the fiscal deficit as a ratio to GDP, gross domestic product, is brought down to 3.0% by 2016-17. The Patel panel fight that the monetary policy decision-making should be vested with a monetary policy committee, MPC. I went on to recommend that the governor of the RBI should be the chairman of the MPC. It felt that the deputy governor in charge of monetary policy could be the vice chairman. The executive director in charge of monetary policy could be its member. It could have 2 external members. The full-time external members would have full access to information analysis generated within the Reserve Bank. Black Circle, it said all fixed income financial products should be treated on par with bank deposits for the purposes of taxation and TDS. With a sharp rise in the ratio of agricultural credit to agricultural GDP, the need for subventions on interest rate for lending to certain sectors would have to revisit it. Monetary Policy Committee, MPC. The RBI Act, 1934 has been amended by the Finance Act, 2016 to provide for a statutory and institutionalized framework for MPC for maintaining price stability while keeping in mind the objective of growth. MPC will fix the benchmark policy rate, repo rate, required to contain inflation within the specified target level. MPC will have 6 members, 3 from RBI and 3 will be appointed by the central government. The MPC will meet 4 times a year and shall publish its decisions after each meeting. The government, in consultation with RBI, has notified the inflation target, till the 31st of March 2021, inflation target 4%. Upper tolerance level 6%, lower tolerance level 2%. Black Circle, a committee-based approach for determining monetary policy, will add a lot of value and transparency to the monetary policy decision. Nachikit Moore Committee for Financial Inclusion. The Committee on Comprehensive Financial Services for Small Businesses and Low-Income Households, headed by Nachikit Moore, sets the following goals to achieve before the 1st of January 2016. Bank accounts for all adult residents. Only a third of adults have a bank account. Deposit and withdrawal facility in a 15 minutes walking distance with 1 access point per square kilometer with 400 people. Nearly 90% of the urban areas meet this criterion, whereas less than 3% of rural areas meet the same. Black Circle term life sum assured to GDP to